We started this topic last week, Saturday. So which
Yes,
of the area do we stop before my battery low?
we stopped at limitations.
Eh?
Where you say something, we stopped at the number two, limitation, where you said if the branch is mainly for collection of information,
Okay,
that
okay, okay,
they will not be taxable.
okay. Thank you very much. Thank you. So let me recap again for some of us that are not around. Taxation of non-residents. In this, the objective of this taxation of non-resident is to provide general description of Nigeria tax law for non-residents. Under this topic, we'll be talking about resident company and non-resident company. So resident company is a company that is incorporated and registered in Nigeria through corporate company and allied matter acts. A company that is incorporated and registered in Nigeria through company and allied matter acts or through CAC, they are called resident company. Why non-resident company means a company that does not incorporated nor register in Nigeria, but derive profits in Nigeria. So we now talk about residential rule. Residential rule. Residential rule for resident company and resident individual. What is the residential rule for resident company and resident individual? We said income of a resident taxpayer, either individual or company, they are assessed to tax on a global or worldwide income. What this one means is that for a resident company, his profit or income will be assessed to tax based on all the profit he derived, both from his head office and its various branches, based on its head office and its various branches. All the branches that they have in other countries, their profit after being subjected to tax in other country will also be liable to tax in Nigeria because the country of their residence is Nigeria. So resident rule for non-resident company. Non-resident company, they are liable to tax only on the profit that they derive in Nigeria. A non-resident company are liable to tax in Nigeria only on the profit that they derive in Nigeria. So that is that. And a non-resident company, for a non-resident company to be liable to tax in Nigeria, it means they must have fiscal economic presence. They must have a fees base in Nigeria or significant economic presence. For a non-resident company to be liable to tax in Nigeria after deriving income in Nigeria, they must have either a fees based in Nigeria or significant economic presence. What is a fees base? A fees base means a branch or a factory or warehouse. A non-resident company, they have a branch in Nigeria, or they have a factory in Nigeria, or they have a warehouse in Nigeria, or they have a assembly point in Nigeria. All these, they are what? Fees based. Significant economic presence means they don't have any office in Nigeria, but they operate through Nigeria domain using digital transaction. They operate through Nigeria domain using digital transaction. That is significant economic presence. Now, let's look at concept of dual resident. Concept of dual resident. Dual resident simply means a situation whereby a company or individual have more than one place of residence. As an individual, when you look at residential rule for individual are assessed to tax based on their place of residence. Where you are residing is where you are paying your tax to, not where you derive your income. You may be working in Lagos State, but you are residing in Ogun State. What that one means is that your place of residence is Ogun State, is where you are going to remit your tax to, not Lagos State. Dual residence simply means a situation whereby a company or individual has more than one place of residence. Now, let's look at dual resident for a local company. Dual resident for a local company. A local company, dual resident for a local individual. Local individual means Nigeria resident, somebody residing in Nigeria. Somebody that is residing in Nigeria. So, dual resident for a local individual. When an individual in Nigeria, me and you, either we are employee or we are sole trader, we are residing in Nigeria, we now have more than one place of residence. Let me use example. Alhaji Ganiu married 3 wives. One of his wives is in Lagos State, while the second wife is in Ogun State, while the third wife is in Oyo State. So because of the marital life of Alhaji Ganiu, so he doesn't have a particular place that he normally stays as his usual place of residence. He normally rotates. Sometimes he will stay in Lagos, sometimes he will stay. So, as a result of that, Alhaji Ganiu is a dual resident individual. Now, how do you determine where Alhaji Ganiu will pay his tax to? We are going to
Sorry, I can't hear him again. Am I the only one?
Huh?
I could not hear you again. I don't know if I was the only one with the problem.
Okay. Can you hear me now?
Hearing you, sir.
You can hear me?
We stopped hearing you. We can hear you now.
Okay, thank you. Very much. So, principal place of residence. In such case, how do we determine his principal place of residence? Assuming that individual is an employee, his principal place of residence means out of the 3 places that the person is staying, which one is nearest to his place of work? That is for an employee. So now, for the sake of time, let's look at dual residence for a company. Dual residence for a company means when a company has more than one place of residence. A company has more than one place of residence. They have office in Nigeria. They have office in abroad. It means they are dual residents. They have head office in Nigeria. They have branches in abroad. It means they are dual residents. They are what? Dual residents. In such case, how do we determine where they will pay their tax to? That one will take us to tax implication of relationship between interrelated companies. That's implication of relationship between interrelated companies. What are the interrelated companies? Number one, under this tax implication between relationship between interrelated companies. Relationship between Nigeria branch and foreign parent company. Relationship between Nigeria branch and what? Foreign parent company. A company, they have foreign head office. Their head office is in foreign country. They now have a branch in Nigeria. It means that company is a non-resident company because the company does not incorporated, non-registered in Nigeria. Because the head office is in abroad. Head office in abroad is in abroad. They just have branches in Nigeria. The head office is in abroad. They have a branches in Nigeria. So what is the relationship between that? Number one, tax implication under Nigeria branch and foreign parent company. No incorporation is required for the Nigeria branch. Take for instance, Anderson Incorporation is a United States company. They now have a branch in Nigeria. One of the tax implications is that no incorporation is required for a Nigeria branch. That the Nigeria branch, they are not required to register under CAC as a legal entity. They will still be using the name of Anderson Incorporation. They will still be using the name of their head office. They don't require to come and register in Nigeria as Anderson Nigeria Limited. No, because it's a branch. However, secondly, that Nigeria branch will be treated as a corporate entity in Nigeria. It's going to be treated as a corporate entity in Nigeria, meaning that the profit is derived in Nigeria will be subjected to tax in Nigeria. The Nigeria branch of a foreign parent company, if it derives profit in Nigeria, such kind of profit will be subjected to tax in Nigeria. If you want to look at tax implication between Nigeria branch and foreign parent company, 2 points is what you are going to mention. Number 1 point is no incorporation is required for the Nigeria branch of a foreign company in Nigeria. They will still be using the name of their head office, and that's the incorporation. Aside from using the name of the head office, they will treat them as a corporate entity. What that one means is that the profit that they derive in Nigeria will be subjected to tax in Nigeria. However, there are some conditions whereby the profit of a Nigeria branch will not be liable to tax in Nigeria. What are the conditions? Where a profit of Nigeria branch will not be liable to tax in Nigeria. Number 1 condition is where the branches of where that Nigeria branch of a foreign company is used solely for storage of goods or display of goods. Where that Nigeria branch of a foreign company is used solely for storage or display of goods. Number 2 condition, where the branch is used for collection of information only. That Nigeria branch, they can use it for display of goods. Take, for instance, Adidas. They now have branches in Nigeria. That branches in Nigeria, they just use it as a showroom to be displaying their goods. They are not selling in that branches. If you want to buy a product of Adidas, you have to order online. They will send it to you from abroad. But they have a showroom in Nigeria. That showroom is used for display of goods only. In such case, their branches in Nigeria will not be liable to tax in Nigeria. Or second condition, when the branches is used for collection of information, they have a branches in Nigeria. They just use it to collect information on how consumer reacts to their products. If you want to buy their product, you have to order online and they will send it in abroad. But the branches that they have in Nigeria is for collection of information about how people feel or after sales service. That is Nigeria branch and foreign parent company, or we can call it Nigeria branch and foreign head office. Number two, tax implication of relationship between interrelated companies. Number two is Nigeria subsidiary and foreign parent company. What is the tax implication of Nigeria subsidiary and foreign parent company? A Nigeria company, in a foreign company, parent company, they have a subsidiary in Nigeria. What is the tax implication? Number one, under Nigeria tax law, the subsidiary of a foreign parent company must be incorporated in Nigeria. The subsidiary of a foreign parent company must be what? Incorporated. It means that the subsidiary, they will incorporate it in Nigeria. They will register as a company in Nigeria under Corporate Affairs Commission. Take, for instance, Mobi International. They now want to have a subsidiary in Nigeria. What that one means is that their subsidiary in Nigeria will not be bearing Mobi International. It will be bearing Mobi Nigeria Limited. It will go and register under Corporate Affairs Commission. And second is, the profit derived by their subsidiary will only be liable to tax in Nigeria. The profit derived by their subsidiary will only be liable to tax in Nigeria. Another tax implication is the foreign equity participation may be 100% fully owned or less than 100%, which is partially owned. What that one means is that parent company that is in abroad, they may be the one that have 100% shareholding structure in their subsidiary in Nigeria, or they may have like 80% shareholding structure in their subsidiary in Nigeria. It depends. They have a right to have 100%. They have a right to have less than 100%. Another tax implication is dividend distributed by the Nigeria subsidiary of the parent company are frank investment income and shall be exempted from tax in the hand of the parent company. You know, the parent company has a share in that subsidiary. Every year, that subsidiary will be paying the parent company dividend. Such kind of dividend are treated as a frank investment income. Such kind of dividends are treated as a frank investment income in the hand of the parent company. Number 3 tax implication of interrelated companies: overseas branch of a Nigeria company. 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 Let's look at tax implication of company. Dangote PLC. It now has a branch overseas. A Nigeria company, Dangote Nigeria PLC, they now have a branch in another country. What is the tax implication? What is the tax implication? Number 1 tax implication is the profit of overseas branch of a Nigeria company is deemed to be derived in Nigeria and is therefore fully liable to tax in Nigeria. The profit of overseas branch of a Nigeria company is deemed to be derived in Nigeria and is therefore fully liable to tax in Nigeria. When we are doing double taxation relief, that double taxation relief is overseas branch of a Nigeria company. A Nigeria company, they have a branch in abroad. The profit of that their branch in abroad will be subjected to tax in abroad. We also bring the profit again to Nigeria. It will also be subjected to tax in Nigeria. So, overseas branch of a Nigeria company is the double taxation relief that we did in the last 2 lectures. Second tax implication under that is the assets of the branches are liable for capital allowance claim in Nigeria. The assets of the branch are liable for capital allowance claim in Nigeria. The assets of that branch, that overseas branch, that the head office is in Nigeria, they now have branches overseas. The asset of the overseas, since the profit of the overseas is liable to tax in Nigeria, the asset too that is not in Nigeria, that is in abroad, they will claim capital allowance on the assets before they pay tax on the profits. Number 3 tax implication: loss incurred by that their branches, overseas branch, can be set off against profit of their head office. So far as the business that they are doing in overseas is the same source of business that the head office in Nigeria is doing. So the loss incurred by the overseas can be used as a relief from the profits of the Nigeria branch. Provided that the overseas branch and the Nigeria head office, they are in the same line of business. Another tax implication under that is double taxation relief is available for any foreign tax suffered by the overseas branch. You know that overseas branch, the tax authority in abroad, they will collect tax on the profit. When they now take the profit to the head office in Nigeria, Nigeria tax authority will want to collect tax. As a result of that, we are going to calculate double taxation relief because they have suffered foreign tax. So that is that. Another tax implication of interrelated company, overseas subsidiary of a Nigeria company. Overseas subsidiary of a Nigeria company. What this one means is that the subsidiary, a company in Nigeria has a subsidiary in abroad. It means the parent company is in Nigeria, while the subsidiary is in abroad. The parent company is in Nigeria, while the subsidiary is in abroad. Overseas subsidiary of a Nigeria company. What is the tax implication? Number one tax implication. The profit of the overseas subsidiary is not deemed to be derived in Nigeria, and we therefore not liable to tax in Nigeria. The profit of overseas subsidiary is deemed not to be derived in Nigeria and is therefore not liable to tax in Nigeria. Subsidiary is different from branch. In this topic, you must know the difference between subsidiary and branch. Second tax implication, it is only dividend received from such overseas subsidiary that will be considered for Nigeria tax purpose. Another tax implication, technical and management fee paid to Nigeria company by the overseas subsidiary will be subjected to tax in Nigeria. The subsidiary may be paying their parent company technical and management fee. Since the parent company is in Nigeria, they will receive technical and management fee as an income. Such kind of income is subjected to tax in Nigeria. Another one, capital allowance on the asset of the overseas subsidiary cannot be claimable. Capital allowance will not be claimed on the asset of overseas subsidiary. But if it is overseas branch, capital allowance on the asset can be claimed. So please, let's know the difference between branch and subsidiary. Next heading now, circumstances under which a non-resident company will be liable to tax in Nigeria. a non-resident company that does not incorporated or register in Nigeria, what are the circumstances where their profits will be liable to tax in Nigeria? Number one is where the non-resident company has a fees base in Nigeria. They have a fees base in Nigeria. Fees base in Nigeria. It means they have a branches in Nigeria, or they have a factory in Nigeria, or they have a installation point in Nigeria, or they have an assembly point in Nigeria. Fees base means branches, factory, warehouse, installation points, assembly points. They have that in Nigeria. When a non-resident company has that in Nigeria, they will be liable to tax in Nigeria. The only condition where a non-resident company will not be liable to tax in Nigeria if they have a fees base in Nigeria is where the fees base is used for display of goods or is used for collection of information. Another circumstance where under which a non-resident company will be liable to tax in Nigeria. Another circumstance. Number two circumstances is where the non-resident company derive income through dependent agents. Where the non-resident company derive income through dependent agents. Under taxation of non-resident, we have two types of agents. We have two types of agents. Independent agents and dependent agents. Independent agent simply means an agent that can stand on their own without 100% depend on their principal. Independent agents means such kind of agents does not depend only on the good of the principal only. Even if the principal does not supply good to them again, they will still be continue running operation. They don't depend on the principal only. They are not established because of the principal that supply them good from abroad. No. If they are not receiving any good from their principal again, they will still exist. Why dependent agent? Is an agent that depends fully on the good of the principal. These dependent agents was established in Nigeria solely because of the principal in abroad. And if the principal stop supplying goods to the agent in Nigeria, that agent will cease to exist. So in such case, one of number two circumstances where income of the non-resident will be liable to tax in Nigeria is where income derived in Nigeria is through what? Dependent agent, or where the non-resident derive income through dependent agent. But when they derive income through independent agent, such income will not be liable to tax in Nigeria. Rather, it is the independent agent that will pay tax on their own name. But if it is dependent agent, it is the non-resident that will pay tax, not the dependent agent. Another circumstance where income of a non-resident company will be liable to tax in Nigeria is where the non-resident company derive income or profit for turnkey project from a turnkey project. Where the non-resident company derive profit from a turnkey project. What is turnkey project? Project that is a one-off project. The non-resident company come to Nigeria to do a one-off project. One-off project like, they come and install software for a company, or they come and do construction of a building. Foreign company, foreign construction company, they just employed award contract to them, come and construct this bridge to us only. After constructing the bridge, they are going back to their country. In such case, the profit derived from such turnkey project is going to be liable to tax in Nigeria. One-off project. Turnkey project means delivery, survey. It can be marketing survey. They come and conduct marketing research in Nigeria. After they finish conducting the research, they will go back. Any income they derive from the marketing research will be liable to tax in Nigeria. Another one, where the income of the non-resident company derive income from professional management and technical service rendered in Nigeria. They come and render professional management technical service in Nigeria. Such kind of income that they derive in Nigeria will be liable to tax in Nigeria. Another circumstances where income of a non-resident company will be liable to tax in Nigeria, where the non-resident company derive investment income such as interest, rent, royalty, dividends, they will be liable to tax in Nigeria. So those are the circumstances where income of a non-resident company will be liable to tax in Nigeria. Now, let's look at turnover assessment of a non-resident company. Sometimes, this non-resident company, they will just come to Nigeria, they will earn income. They will not incur any cost. They will just have only turnover. They will not incur any cost. How do we assess them to tax? If they have only turnover, then don't have any cost. Maybe they sell some goods, they supply some goods, they come to Nigeria to come and supply some goods, or to come and do a business. They now derive an income. Such kind of income, they do not incur any cost. In such cases, we are going to assume that their turnover, 20% of it is the taxable profit. In such cases, we are going to assume that their turnover, 20% of their turnover is the taxable profit. Once we get our taxable profit, they will only pay company income tax. They will only pay company income tax, and it's going to be at the rate of 30%. A non-resident company that don't have a fees base in Nigeria will only pay company income tax. But if they have a fees base in Nigeria, they can pay company income tax, they will also pay education tax. So when a non-resident company derives turnover only, they don't have any cost. Such turnover, how do we assess them to tax? 20% of the turnover will be recognized as assessable profit or taxable profit. And 30% will be computed as company income tax. So that is turnover assessment of a non-resident company. Another thing we need to know under turnover assessment of a non-resident company, where the non-resident company, through their fees base, they render consulting service, technical service, management service. How do we assess them to tax? When they derive an income through management service, technical service, consulting service, we only deduct withholding tax of 10%. We only deduct withholding tax of 10%. Look at based on the amendment he made to what are the finance 2019 to non-resident. Number one, withholding tax shall be final technical. Secondly, Finance Act introduced what is called significant economic presence. What that one means is that non-resident company, they don't have a fees base in Nigeria, but they operate through digital transaction, through technology, through the use of electronic, online in Nigeria. They use it to derive income in Nigeria. In such case, they will be liable to tax. Non-resident companies are liable to file company income tax return only when they have a fees base in Nigeria. Now, let's look at income derived from having significant economic presence. When you have
Excuse me.
significant, yes.
Sir, please, you said something about withholding tax being the final tax. Please, can you explain that better?
Yes, I said that. What I'm saying is a Nigeria parent company, a Nigeria parent, a Nigeria subsidiary of a foreign parent company. When dividend investment income means income that has suffered tax in the hand of the payer, in the hand of the payer, somebody that paid the income, should not suffer tax again in the hand of the receiver. Dividend is a frank investment income because dividend is paid out of profit after tax. After they have computed tax is when they pay dividend. It has been subjected to tax in the hand of the company before company distribute it to shareholder. So that is it.
Sir, excuse me, sir, please. Sir, does it mean after they rendered the professional service in Nigeria, right? And they paid withholding tax. So is the law saying that there should not be tax in their own country, like in their country of residence now, since the withholding tax is going to be the final tax?
On which type of income?
Professional service. Income from professional services.
Income from,
professional
yes,
service.
it will not be taxed in their country. It will be final tax in Nigeria.
Okay, sir. Thank you, sir.
Yeah. Income derived from having significant economic presence. When you derive a turnover that is more than 25 million through this following: downloading service of digital content, music application, game, e-book. All these people, they will not come to Nigeria. They are done through online. And such kind of income is more than 25 million. It will be subjected to tax in Nigeria. So, example of significant economic presence means downloading service of digital content like video, music, application, game, e-book. They will come and download it in Nigeria domain. And such kind of people, such kind of companies, people will be downloading from them. They are deriving income in Nigeria, but they are not, they don't have a fixed base in Nigeria. In such case, they will be liable to tax in Nigeria. So all these are examples of significant economic presence. For the sake of time, let's look at the question. Mr. Promise Faith is an employee of Canada company based in Toronto. In an attempt to widen scope, the company decided to second Mr. Promise Faith to Nigeria in January 2012 to open an office to open the Lagos office on the following time. He's entitled to receive an equivalent amount of 280,000 in Canada, and this is to be paid of net of tax. He is to be paid 475,000. This is subjected to Nigeria tax. The tax paid on his income in Canada amounted to what? Equivalent of 60,000. He had 4 children and 2 dependent relatives with him in Lagos. Required, compute the credit given to Mr. Promise Faith on his income made in Canada, assuming double taxation agreement between Nigeria and Canada. Let's look at it. Mr. Promise. What type of tax Mr. Promise is subjected to?
Personal income tax.
Personal income tax. So we compute Mr. Promise tax using personal income tax format. Under the personal income tax format, we have earned income. One of his income, there are 2 types of income Mr. Promise earned. He earned a foreign income. He also earned Nigerian income. His foreign income is 240. How do we get 240? First and foremost, they paid him 280 net of tax. And we were later told that the tax he paid in Canada is what? 60,000. 60,000 plus 280. It will give you what? 340. The Nigeria income is given. His total income is 815,000. When you less that, you now less tax relief. There is a rule for tax relief. We call it consolidated relief allowance. 200,000 plus 20% of total income is the rule under personal income tax. So 200,000 plus 20% of 815,000. When you plus the 2, it will give you 363,000. You get your chargeable income. You now apply tax rates, personal income tax rates. First 300,000 at 7%. You use that. Out of that, his income remain, when you minus 300,000 from his chargeable income, it will remain 152. That 152 is at 11%. 11% of 152, it will give you this. So the total tax Mr. Promise is going to pay is 37,720. Mind you, Mr. Promise have already paid 60,000 in abroad. As a result of that, we are going to consider double taxation relief. How do we do double taxation relief for individual? Lower of Nigeria tax rates or Commonwealth rates. The Nigeria tax rate, how do we get Nigeria tax rate for individual? The total tax you want to pay in Nigeria is 37,720. Why is total income in Nigeria is 815,000? When you use that. Foreign tax paid, he paid 60,000 in Canada. His gross income in Canada is 340. So out of these two, which one is lower? Nigeria tax rate is lower. So our double taxation relief will be Nigeria tax rate, which is 5%. So when we want to compute our double taxation relief, 5% of out of his total income, out of these two income, which one want to suffer double tax? It's only the foreign income, which is the Canada income. So our double taxation relief will be 5% of the Canada income. 5% of it, it will give you 23,750. When you minus it from the tax you're supposed to pay in Nigeria, the net tax payable is going to be 13,970. So that is the net tax payable. Let's look at B part of the question. The B part of the question said, Gibraltar Mikado Incorporation is a non-resident company. They carry out some activities during the year ended 31st December 2013. Gibraltar Mikado is an oil servicing company. A careful study of its tax return filed with Federal Inland Revenue Service show the following. They have income that they derive from Mobi. They are in dollar. Income from Shell. Income from Chevron. Income from Pan African Nigeria. Income from Agib. Income from Philip Oil. So at the end of the day, all these are total income. Require, compute the total turnover of the company. Second, compute the tax payable by the company, assuming it has a tax credit of 15,000 $15,000. $15 million, sorry. We have been told here, FRS has to determine or assess, FRS has to assess and charge on turnover basis. This company is a non-resident company, Mikado, Gibraltar Mikado Incorporation. It's a non-resident company. And they don't have a fixed base in Nigeria. They don't have any office in Nigeria. But they come to Nigeria to come and derive income in Nigeria. The information given to us is only about the income that they derive. They did not show us either they incur any cost. How do we determine the tax that they will pay? First and foremost, we are asked to compute the total turnover. The total turnover means the summation of all the income that they derive in Nigeria. So if you want to get the total turnover, you sum all the income that they derive in Nigeria. At the end of the day, it's giving you 785,000. After that, we want to compute the tax payable. If you want to compute the tax payable, we are going to use the rule of turnover assessment. The rule of turnover assessment, we say that if a company derive only turnover in Nigeria, they don't have any cost, 20% of the turnover should be taxable profit, and a tax rate of 30% should apply. Let's go back. By looking at that, for us to compute the tax liability, the turnover is 785,000. The deemed taxable profit is going to be 20% of 785,000, which is 157,000. The CIT tax is now going to be 30% of the taxable profit is the CIT, company income tax that they will pay. Mind you, this company have already paid withholding tax credit. They have already paid withholding tax before. They have a withholding tax credit of 15 million. you minus the 15 million for 47,100. At the end of the day, the tax payable that they will get is 32,100,000.
So please, I have a question.
Okay.
In the number one question we solved, I'm yet to understand where we got the 200 plus 20% tax relief.
Do you have in your skill, do you do personal income tax?
Sir?
When you are in skills, do you do personal income tax?
Yes, sir.
Personal income tax, when you are in skill, do you do tax? Be serious.
Yes, sir.
Do you do tax?
Yes, sir.
And you do personal income tax?
Yes, sir.
Go and check. Is given in personal income tax, consolidated relief allowance is 20% plus 200,000 plus 20% of your income, your total income or your gross income. It's already in the format of personal income tax. Do you understand?
Yes, sir.
Unlike it, just like the table 2, the tax rate of personal income tax. Can you state the tax rate of personal income tax? Or you state it?
So I can't remember everything, but I already saw the 7% and the 11% there. 1121. 71121.
First 300,000 at 7%. Second 300,000 at 11%. Next 500,000, 15%. Next one, 19%. 500,000. You can remember?
Yeah.
Any other question?
21%. I know there's 21%.
Yes, 1.6 at 21%. Any other question? Let's look at question 2.
Sorry, sir. So I want
Okay.
to ask a question. When you were talking about company with significant presence in Nigeria, such income is taxable. So I was now wondering how the tax authority will be able to tax most of these content creators that generate income from their monetized IG pages, their YouTube channels, Facebook, and most of these social medias, seeing that Nigeria does not really have a database that is active and strong. So how?
Yes, as at present, FRS, they are working on significant economic presence. Do you hear me? Can
I'm
you
with
hear
you,
me?
sir. I'm with you. Yeah. Loud
They
and
are
clear.
working on significant economic presence that all these people doing digital online business, how do we tax them coming to Nigeria business domain to come and make profit? How do we tax them? They are coming with a lot of policy on how they can put them in the tax net. One of the policies that they are recommending is that the user of the service, we have to pay through bank app now, through his bank detail. At the point of the payment, we can deduct the tax. Do you understand?
Yes, sir. I'm following you.
You want to pay for a content. When you want to pay, at the point of your payment, when you initiate your payment, tax will be deducted automatic. That is what FRS is working towards on significant economic present. As I'm talking to you right now, they have not really achieved how to tax a company that operates through significant economic presence. Most of the companies doing all the digital, Facebook, Twitter, making all this content on all this online, they are still going away with profit without tax. Most of them, I'm not saying all of them, but FRS is working on how they can ensure that every content creator, every Facebook advertisement, every Twitter, TikTok, I mean the other one, all of them, when you make an advertisement there, you make a profit or you sell a service, you derive income, you will be taxable. They are working on that as at present. Do you understand?
Very clear, sir. Very clear, sir.
Okay. Now, let's look at question 2. This question 2 is very long, but it has some irrelevant. So somebody can read the question 2 for us. I'm fasting today. I'm tired. Volunteer.
The threat of war between Russia and Ukraine started some years ago and has been having serious negative impacts on most corporations operating in the two countries. Consequently, many corporations in both countries have shut down their businesses, while those still operating are incurring huge losses. Many multinational enterprises in the two countries. Next slide, please.
Okay. Continue.
Have located their businesses to countries considered to be safe and investment friendly. Minions Incorporation is a manufacturing company that was incorporated in Japan 2001 and has subsidiaries in Ukraine and some Asian countries. The Ukraine subsidiary happens to be the highest contributor to the group performance over the years. However, due to the war in Ukraine, most of the resources have been diverted to the Asian countries operations with plans to equally. Next slide, please.
Okay.
Plan to equally exploit Africa markets. In view of this, Minion Nigeria Limited was incorporated in Nigeria in January 2021. Minion Nigeria Limited is a subsidiary of Minion Corporation. The company is into manufacturing of fast-moving consumer goods, and its operational base in Nigeria is located in Esa, Osun State. Minion Nigeria Limited commenced business in Nigeria in January 2021, and its financial year ends is December 31st, which is the same as its parent country, Minion Corporation in Japan. The first set of financial statements prepared by Minion Nigeria Limited was for the year ended December 31st, 2021, and was audited by the Nigeria branch of a reputable audit firm in Japan. The first set of financial statements prepared by Minion Nigeria Limited was for the year ended. Okay, I've read that part. On September 15, 2022, Minion Nigeria Limited received a letter from the Federal Inland Revenue Service (FRS) in Osun State requesting for the annual corporate tax returns of Minion Nigeria Limited. The general manager of the company was surprised to receive such letter from the FRS. He claimed that the company had paid personal income tax of its employees and directors, valued added tax on imported equipment, and relevant custom duties. He argued further that since the parent company is not registered in Nigeria, there is no reason why it should be liable to corporate taxes in Nigeria. The managing director of the subsidiary company in Nigeria, with the approval of the head office in Japan, appointed your firm as the company tax consultant to help unravel the issue of payment of corporate taxes by resident and non-resident companies operating in Nigeria. He also submitted to your firm the statement of profit or loss for the year ended December 31st, 2021, after conversion of the transaction in head office Japanese currency yen to Nigerian naira.
Okay. We are now giving the profit, the turnover, the expenses. We are giving the net profit, all the expenses. At the end of the day, you are required to present the following additional, your firm was presented the following additional information for the Nigeria subsidiary. Miscellaneous income. This consists of income realized from sales of component parts to head office in Japan. The transaction was certified and have been made in an open market. Another one, legal expenses, consists of debt collection, preliminary expenses, land acquisition, retainership fee. Allowance for doubtful debt is made up of allowance for doubtful debt, specific allowance for doubtful debt, bad debt written off. Repair and maintenance is made up of improvement to office building, repair of plant and machineries. Admin expenses is made up of court fine, office expenses, subscription to Nigeria Japan Trade Mission, provision for Japanese book to some public secondary school in Osun. The schedules of qualified capital expenditure is as follows. Factory, it was acquired January 2021. Factory building, office building. You are required as the company tax consultant, your firm is required to prepare a letter to the management of Mission Nigeria Limited. Take into consideration the tax implication of what? Number one, distinction between resident company and what? Non-resident company. Who can differentiate between resident company and non-resident company?
Resident company that the company incorporated in Nigeria and then make profits in Nigeria, and they are paid and they are liable to pay tax on their profit made in Nigeria.
Okay.
While the non-residents are the one not incorporated in Nigeria, but they are the one not incorporated in Nigeria.
But
they derive income from Nigeria.
they derive income of profit in Nigeria.
Profits.
Relationship, their head office is in foreign parent. What is the relationship? Nigeria branch and foreign what? What is the tax implication when you want to mention relationship between Nigeria branch and foreign parent company? Number one is no incorporation is required for the Nigeria branch. Abi? Profit derived by the Nigeria branch of foreign parent company will be liable to tax in Nigeria. Relationship between Nigeria subsidiary and foreign parent company. A company, their head office, their parent company is in abroad. They now have a subsidiary in Nigeria. What is the relationship? That Nigeria subsidiary will be required to register as a corporate entity in Nigeria under Corporate Affairs Commission as its own entity. And the profit derived by that Nigeria subsidiary will be only be liable to tax in Nigeria. Dividend paid by that Nigeria subsidiary to foreign parent company will be treated as what? Frank investment income. What is the tax implication of overseas branch of a Nigeria company? A Nigeria company, they have head office in Nigeria. They now have overseas branch in abroad. What is the tax implication?
The profit from the branch will be taxed in Nigeria.
Will be taxed in Nigeria. Second tax implication, since profit is taxed in Nigeria, the asset of the branch, of the foreign branch, will be entitled to what? Capital allowance. Since their profit is taxed in Nigeria, the asset too will be entitled to capital allowance in where? In Nigeria. Do we understand? Do you understand?
Yes, sir.
Overseas branch of a Nigeria company. They have an overseas branch in overseas. The head office is in Nigeria. Another thing that we need to mention, if the overseas branch make a loss, that loss can be used to set off profit of the Nigeria head office. Another thing we need to mention, double taxation relief will be double taxation relief will be given on any foreign tax suffered by the overseas branches. Because that overseas branches, the profit, they will have collect tax in it in abroad. And Nigeria government will want to collect tax in it. It will have double taxation. So let's go to the solution. Your solution in this question, you are asked to write a report. As a tax consultant, your firm are required to prepare what? A letter to the management of Milton Nigeria Limited, taking into consideration. They are now giving you what will be in the content of your letter. So if you look at my solution, I write it in form of a letter. ABC and Co. is a tax consultant. ABC Avenue, Lagos. Date of the letter. The managing director, Milton Nigeria Limited, SRK, Industrial Layout. Dear sir, taxation of non-resident, resident and non-resident. With refer to your mail dated February 10 on the above subject matter, requesting us to unravel the issue on payment of corporate taxes by resident and non-resident company operating in Nigeria. Please find below the information that will facilitate your better understanding You now be talking about the content one by one. The content, number one is we should differentiate between resident company and what? Non-resident company. You differentiate. Resident company is a company incorporated or registered in Nigeria. The income derived by non-resident company will be liable to tax in Nigeria. Why non-resident company? Is a company that does not register or incorporated in Nigeria but derive income in Nigeria. Such kind of income that they derive in Nigeria, they will be liable to tax in Nigeria. The relationship between Nigeria branch and a foreign parent company. You mentioned that too. Now, let's go to the calculation of this question. Whereas part of the requirement is advise the corporate tax payable by the two businesses in Nigeria. I want to ask a question. Looking at this question, which type of interrelated company is in this case study? Which type of interrelated company? Who can tell me? Read it. Which type of interrelated company? Is it Nigeria branch and foreign subsidiary? Is it Nigeria subsidiary and foreign head office? You understand? Read. Who can tell me which type of relationship?
Is Nigerian subsidiary and foreign parent?
Where do you get that?
From where your cursor is. The paragraph.
Okay. Yes, you are right. Milton Nigeria Limited is a subsidiary of what? Milton Incorporation. Nigeria subsidiary. And what? Foreign what?
Foreign parent. Yes.
Now, let's go and look at the tax implication of that. Nigeria subsidiary and foreign parent company. When we have Nigeria subsidiary and foreign parent company, we said the subsidiary of a foreign parent company must be incorporated in Nigeria, and the income or profit is liable to tax in Nigeria. Does the subsidiary incorporated in Nigeria in this question?
No,
Yes.
sir.
Yes, because it's Nigeria Limited.
Milton Nigeria what?
Limited.
Okay.
Limited. They said they can have 100% equity. We don't know. But what we are saying is their profit will be liable to tax in Nigeria. Now, looking at this question, when I can say this question, people was thinking it's a double taxation. It's not a double taxation. Look at the last paragraph. They said the profit of the transaction of the head office, Japanese currency, to Nigeria naira. They say they also submit the report of the head office, the financial profit and loss account of the head office. They also give us. Ladies and gentlemen, which profit is liable to tax in Nigeria here?
The Nigerian profit.
Only the Nigeria profit.
Yes.
Does the Japan profit liable to tax in Nigeria?
No, sir.
No, sir. Mm.
Japan is the head office. The profit of head office, does it come to Nigeria?
No, sir.
No. It's only the Nigeria profit. Do we understand? And ladies and gentlemen, what that one means is that we don't need anything on this Japan. We are only after Nigeria. Because Japan is the parent company. They now said they give us the profit of the parent company, which is located in Japan. Business that they do in Japan. Are we going to collect tax in it in Nigeria?
No, sir. No, sir.
So we are giving this. We start with net profit. Net profit. What is the net profit? This is the net profit of the Nigeria branch, Nigeria subsidiary. You add disallowable expenses. Number one disallowable expenses that we have in this question is depreciation. We also have foreign exchange loss provision as part of the expenses. Is disallowed foreign exchange loss provision. But if it is exchange loss realized, it's allowed. The provision for exchange loss is disallowed. So if you look at, let's go back to the expenses. Out of these expenses, let's check around which one is disallowed among them for the Nigeria operation. These are the Nigeria operation is in the middle. Depreciation is disallowed, Abi? Depreciation
Yes,
is
sir.
disallowed.
Mm.
Another one, value-added tax on essential item. Essential item means items that are important for business, that are expenses, that are important for business. Expenses that are important for business. It's allowed. Now, you go down. We have foreign exchange loss provision. We disallow this. Loss on revaluation of non-current asset. We disallow too. At the end of the day, we have a breakdown of allowance for doubtful debt. Look at the breakdown of allowance for doubtful debt. They say specific is 5,000 TRI. Bad debt written off is what? 3,520. Allowance for doubtful debt of this one, what are we going to call it?
Disallowed.
General. Since they have given us specific, this one will be what? This first one will be what?
General.
General. And general provision for doubtful debt, is it not disallowed?
Disallowed.
We disallow it. Repair and maintenance. Look at the component of repair and maintenance. Which one is allowed? Which one is disallowed?
Improvements to office building will be disallowed
Why?
because it's capital in nature.
It is
To
capital.
reflect on the computation of capital allowance also, right?
Yes. It is capital in nature.
Capital in nature.
So we will disallow that. We will disallow that. Administrative expenses. Look at the composition. Which one is disallowed?
Mm-hmm.
Court fine.
Fine is disallowed. Mm-hmm.
Office expenses is allowed. Subscription to Nigeria and Trade Commission is allowed. Provision for book to public secondary school, is it not allowed? It's allowed.
Mm-hmm.
They give public secondary school book. Is it not allowed? It's part of CSR. It's allowed. They subscribe for trade mission, Nigeria and Japan trade mission. It's allowed. Subscription is allowed. Only court fine. So if you go to my solution, depreciation, foreign exchange loss provision, allowance for doubtful debts, loss on revaluation of non-current assets, preliminary expenses, land acquisition, improvement of office building, administrative expenses, all of them are disallowed. When you add them together, you get 38,756. You plus it with the net profit, we are going to get adjusted profit of 276,574. Let's go back to the question again. I failed to discuss one, which is legal expenses comprises of which one is allowed in these legal expenses? Which one is disallowed? Which one is allowed?
Debt collection is
Criminal
allowed.
expenses is allowed.
Yes. Preliminary expenses is allowed, abi?
Disallowed, yeah.
Is allowed or disallowed?
Disallowed, not allowed.
Disallowed.
Okay. Land acquisition,
It's not allowed.
why is it
It's
not
Disallowed.
allowed?
capital
Disallowed.
elimination
It's supposed to be added to the cost of land.
to the cost of land.
Retainership fee, cost of retaining your lawyer.
It should be allowed,
allowed.
sir.
Allowed.
So only two that is not allowed is preliminary expenses and what?
Land acquisition.
Acquisition. So we get our adjusted profit. We now less our capital allowance. We get taxable profits. At the end of the day, we compute your tax liability. Looking at this company, what rate of TIT am I going to use? The question is in thousands. Even if you look at the taxable profit, it's more than 100 million. So when a taxable profit is more than 100 million, what company income tax rate are you going to use?
30%.
30%. Because it's even more than turnover of 100 million. Profit is even more than turnover of 100. It's 30%. That year 2020, which year of assessment are we doing? Year 2023 year of assessment. As that year 2023 year of assessment, the education tax is what? 2.5%. Education tax is computed on which profit?
Adjusted profit.
It's on adjusted profit. Thank you very much. You compute it. Police development levy is 0.05% of net profits. Net profit. So we get the tax. So at the end of the day, my workings, how I compute my capital allowance, you can see that. You can see how I compute my capital allowance. So ladies and gentlemen, please let's try and stop here. I'm tired. I'm fasting. I've not break my fast. So thank you very much. Yeah. Yeah. So we are going to meet the next time. You can study in case you have any question, let me know.
All right, sir.
Yeah. Thank you very much. Thank you for having me. Yeah. Any question?
Hello, sir.
Yes.
My question is concerning the education tax. Is it not 3% since 2023? We are using
It's going to
2.5.
be 3% from 2024 year of assessment.
Okay.
2023 account is going to be assessed to tax in which year?
2024. Okay. Thank you, sir.
Do you understand?
Yes, sir.
Okay. Any other question?
Yes, sir. Yes, I have a question.
Okay.
So for a relationship between Nigerian subsidiary and foreign parents, right? You mentioned something about the dividends being treated as frank investment. Is it like the dividend the parents is earning from the profit of the subsidiary? to be
Yes.
treated as investment in the hand of the parent.
Yes. Yes.
Okay. Okay. All right.
Thank you very much. Any other question? In the absence of no question, we can call it a day. Thank you very much. Yeah.
Blessings for you, sir.
Yeah.